From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day. It's Tuesday, July 5th. Here are the top market stories we're following for you at this hour. A 20-year low. The euro weakened to a 20-year low against the U.S. dollar. Traders betting the ECB will slow down on raising interest rates as the economy risks being tipped into a recession. And eco data on deck. Factory orders, durable goods data, a slew of economic metrics to watch ahead of payrolls on Friday. We're going to break down what it all means for the economy. And fuel pressures. Natural gas soars while oil extended its range-bound run. As Citigroup says crude could fall to $65 a barrel this year. JP Morgan, on the other hand, saying crude as high as $380. We're going to dive into that issue. From New York, I'm Kriti Gupta with Guy Johnson in London. Alix Steele is off today. Welcome to Bloomberg Markets. Guy, I think it's that range that you're seeing even in the oil markets, in the stock market, even in the recession calls that's really moving a lot of the price action.
Absolutely. It's everything today, really, isn't it? Take a look at what's happening with crude. You're seeing a big downside move there. Take a look at what's happening with yields. They're coming down sharply. Equities under pressure. I'll tell you what's going up, though, and that is the economic data. Now, factory orders are a fairly bumpy series. Nevertheless, we have a upside bump to contend with right now. Factory orders coming through. The number, and this is a May number, up 1.6%. The prior number, 0.3. So a significant upside move, but it's still well within the normal kind of range that we've been operating in here. Ex-transportation, 1.7. So even better. We've got the durable goods numbers as well. These are final numbers. These are, again, May data that you need to be aware of. Coming through slightly better than anticipated at 0.8 versus 0.7 last time round. The transport number bang in line. The capital goods numbers as well, also a little better, but not substantially. But the data at the moment, it appears holding in there, which is in stark contrast to what we saw with the manufacturing ISM Friday. Now, remember, we get the services data tomorrow, so pay attention to that. We also get jobs data that we're going to be paying attention to as well. Very much as Kriti laid out, though, we are seeing the story very much focused on the foreign exchange narrative today. But it's basically just an indication, I think, of what else is going on elsewhere. Kriti was talking about this being across the board. She's not wrong. It goes to our question of the day. What does the weak euro tell you about where you should be putting your money? Where does it say you should be investing your money? So let's try and answer that question and try and understand the signals that are being sent here. Christine Aquino joining us, Ira Jersey of Bloomberg Intelligence joining us. Christine, let me start with you first of all. 102 euro dollar. What signal does that send? What does it tell us about where we should bring money to work?
Well, guys, I think it's saying very negative things about Europe for sure. And so I would expect investors really having to rethink any sort of Europe bullish plays, particularly in the equity space that they started this year with. Remember, we started this year with the notion that this is finally going to be the year of European value. That clearly hasn't played out just because of the way that the general economic trajectory and sentiment has really gone in Europe. And now we're again seeing the ECB worrying increasingly about a potential growth slowdown, possibly even a recession. And that really cannot be great for any European assets. I think, part of the European story, you really have to ask, what is driving that currency weakness? Is it something that is fundamentally driven? Is it something that is central bank driven? I think in this case, it's a confluence of both. And it really does paint quite a negative picture for Europe in the second half for sure.
Ira, hop on in here exactly where Christine left off. The idea that is it fundamentally driven or is it central bank driven? And it kind of feels like the dollar story for a very long time was central bank driven. It was the Fed getting ahead of really a lot of these other G10 banks. To what extent is that still the story? And when do we start seeing it go back to the fundamentals of the actual U.S. or European economy?
Well, I think firstly, the European economy is going to be very challenged over the near term. So certainly some of the move is fundamentally driven. But, as you noted, central banks have had a big part to play in the current move in the euro. And the fact that the Federal Reserve now, it looks like they're going to hike to 3.5%, somewhere in that range. The question is, will the ECB start to catch up? And how quickly will it do that. And Christine Lagarde last week did suggest that, hey, maybe 25 basis points and then 50 basis point hikes, so kind of starting to catch up. So there might be an interesting turn in the dollar-euro relationship in the not-too-distant future, thanks in large part to this shift in monetary policy expectations.
Ira, how do we know whether that's going to turn out to be the case? Because at the moment it feels like part of the story is the central bank divide. The ECB's late. But part of it is down to this unknown factor, which is Vladimir Putin and whether or not he's going to turn the gas on or turn the gas off or leave it on. We don't know the answer to that question. But I tell you, it is a huge one. And I don't understand the ECB reaction function in the second half of the year in that scenario. Say the gas does get turned off. Say energy prices go through the roof. Say unions say we need huge pay rises to compensate for us. How does the ECB react in that kind of scenario when growth is being slammed, but inflation is absolutely surging?
Yeah, you know, it's interesting, Guy. We actually just had a call this morning with the Bloomberg Intelligence strategy teams globally, and that was a big topic of discussion. You know, if the gas is turned off and we head toward the winter and you don't see any significant relief on the fuel side, then you'd have to think that real growth in Europe is going to slow substantially. Now, there's one thing for the euro, but to your point, will the ECB be willing to continue to increase interest rates, amid the inflation scare? Now, I think that they will, and they will have to, in part because of their mandate, right? So the ECB does have a single mandate saying you have to get inflation under control. But one of the interesting aspects of this that we note at Bloomberg Intelligence is, look, demand side inflation in the U.S. is much stronger than it is in Europe. So because of that, you can wind up with a significant growth differential and maybe an increasing growth differential between the U.S. and even the U.K. and the rest of Europe because of what's going on in the Ukraine.
Christine, hop back in here and talk about that euro-dollar dynamic that Ira was just outlining here, because we're looking at, I'm trying to pull up this 102 on euro dollars right now, but I'm curious, if we hit parity, how much further could euro weakness go?
Well, Critty, I think we've moved on from the discussions of parity now in Europe. Just looking through some of the morning notes this morning, we're already seeing calls for euro-dollar to hit below parity at 95 euro cents versus the dollar. And so you can really get this sense now of just that decline, continuous decline in the euro that people are expecting. And of course, the flip side of that is this continued strength in the U.S. dollar. But I would also point out that that's not necessarily a good thing, particularly for U.S. corporates. A couple of months ago, we already heard from a bunch of blue chip companies really lamenting the strength of the U.S. dollar in a way that we've never really seen before. And so if this euro weakness, the flip side of that is continued dollar strength, you have to wonder when that's going to start becoming a problem for some of these U.S. companies as well, and when that's going to start eating into their profit, and whether people in the market, investors, will start kind of gleaning more fundamental implications from that beyond the corporate space.
Yeah, it's going to be fascinating to see what the earnings season looks like and how they do talk about that translation effect. Ira, the other factor here as well is just the growth narrative. If Europe craters as a result of the energy crisis economically, I'm assuming that will have ripple effects across the Atlantic. To Christine's point, there's a lot of US companies with a lot of business in Europe. It's a major, major part of the global economy. And if it goes into reverse in a big way, presumably that is going to have a significant effect not only on the US economy, but the way that the Fed thinks about it as well.
Well, certainly the Federal Reserve and every central bank globally is going to think about, hey, if Europe's in a recession, are we going to follow? But I do think there are significant differences between, obviously, the Eurozone and the UK and the US, just in terms of what are our trade flows, where do we, how does the overall economy react? And I do think in the US, we have to disconnect, and Gina Martin-Adams, my colleague on the equity side, always brings this up. The stock market is not the economy, right? So if you do have large multinationals that are seeing their profits crimped a bit because of the exchange rate issue, that doesn't necessarily mean that the U.S. economy has to fall out of bed. And in fact, just the numbers this morning for May suggest that the business sector is still doing reasonably well. Factory orders up pretty healthy. You also had durable goods orders up reasonably well, good as well. So you wind up with maybe a dichotomy between what's going on in Europe because of the significant increase in fuel prices versus the U.S., where yes, prices are higher, but they're also we're also not as reliant on one source of and a foreign source of energy here directly. So I do think that you can have growth okay in the U.S. and still be shrinking pretty significantly in Europe.
Ira Jersey of Bloomberg Intelligence and Bloomberg's very own Christine Aquino. We thank you both, as always, for your insight. Coming up, more on the Euro's weakness, how to position your portfolio in the wake of some of these pretty drastic FX moves. Seema Shah, Chief Global Strategist at Principal Global Investors, joins us next. This is Bloomberg.
This week, all eyes are on Sun Valley, where the titans of tech and media meet to talk business. And Bloomberg will make sure you're part of the action with live coverage and impactful interviews. It all starts Wednesday, July 6th, right here on Bloomberg.
We're looking at an economy losing momentum faster than what we anticipated.
Economists have begun to cut their top-down economic forecasts for GDP.
This is a global story.
Input costs have risen substantially.
We're seeing demand destruction in some areas.
The consumer is on somewhat more fragile footing.
We do expect the Fed to hike rates more aggressively.
The Fed has been driving the car looking through the rearview mirror.
The economy is slowing, and the Fed is saying that's collateral damage.
Companies and consumers need to get ready.
Frankly, we think they can keep going.
I don't think they blink.
We did see some pretty notable downward revisions.
We expect more downgrades.
Those were Bloomberg TV guests weighing in on the U.S. recession outlook. Let's get back to our question of the day, because in addition to factoring in recession, you also have to factor what some of these weak euro signals are telling you. Where do you invest? Our question of the day asks just that. What does a weak euro signal about where to put your money? We're going to ask that question to Seema Shah, Chief Global Strategist at Principal Global Investors. Seema, thank you as always for joining us. We're looking at 102 on euro dollars. We just talked to Christine Aquino and Ira Jersey saying that perhaps that euro can weaker even further. Where do you put your money in that kind of environment?
Look, it's undoubtedly, it's a really tough global environment, not just for Europe, but I think particularly for Europe. And that's what the euro weakness is telling us, is that the European economy is in a considerably worse state than anywhere else in the globe. When it comes to investing, we are still US over Europe. We think that Europe will fundamentally underperform Europe as we go through the remainder of this year. But also, when you're thinking about the US and other countries, you have to start being cognizant of which countries, or which companies, I should say, have significant revenue exposure to Europe. And typically, those are your large cap. So that starts to build us a bit of a question. A lot of people talk about quality and stability, which you typically get in large cap. But you also have to be very, very aware of the exposure that they have to countries like the euro. And as a result, it's actually one of the reasons why we've moved out of large cap and more into the mid cap space.
Any areas in particular in the mid caps that you're going to be watching? What's the best place within mid caps to insulate myself away from this risk? Because some of those mid caps will also be providing services up to large caps. They'll be part of a supply chain. Are there areas that you are seeing quite clearly as being insulated?
So, Guy, it's a really good question. I think everything that you've just pointed out there is exactly why. It's no longer just about taking more of a top-down view. This is an environment where you have to be a little bit more nuanced to understand what are your company exposures. And as you said, some of those mid-caps will be supplying the large caps. Now, from a more fundamental basis, we look at mid-cap and we say, okay, look, that has got exposure to things more like energy and utilities, which will typically, at least in this environment, be a little bit more defensive. So we continue to like energy, but it is certainly a lot more of a significantly more challenging investment story than I think we've been associated with over the last 2 decades.
Seema, let's stick with that energy story, because that's been an inflation hedge to some extent. It's been the latest defensive play in the markets for almost a year now, and it's the trade that's worked. But I'm curious that if we are talking about recession, you kind of have perhaps some of these prices slightly suppressed because of that recession talk. I'm curious when that trade unwinds, because if you're looking at it as an inflation hedge and suddenly you find out we're in the middle of a recession, isn't that the first trade that collapses?
Well, typically, yes. And I think that recession story is inevitably going to be very challenging to the energy commodity space in the near term. But then, when we look at commodities, there is a structural shortage which should actually support prices beyond that near-term weakness. So actually, we continue to like commodities. We continue to like energy. The one concern for us on the energy side specifically is on the regulations. Which countries are going to be bringing in regulations which are going to pare back some of those potential profits for energy companies? So to us, that is the part that we need to watch closest.
There is the potential for energy prices to go sharply higher, though, Seema, here. We could see European gas prices going through the roof if Russia cuts the supply off. We could see energy prices more broadly going much, much higher. JP Morgan talking about $200-300 potentially on the price of Brent. In that kind of environment, all economies are going to suffer. Europe in particular, as we've already highlighted, is going to suffer probably more than most. What are the ripple effects, just economically, just from a macroeconomic point of view, that we need to be thinking about if Europe was to get cut off, see super high energy prices, and see basically an economic collapse, the kind of economic collapse that German unions are beginning to warn about?
I think you've just said it there. I mean, it's devastation for the European economy. I think, this is a tail risk. We're not forecasting this at the moment. But inevitably, this is when we look at valuations, for example, for Europe, European valuations are very attractive. Why are we not overweight on that side, and why a lot of investors not overweight? It's because of that fundamental tail risk that is, it seems looming larger and larger. So we have to be really familiar with this. Now, from a global perspective, we have a baseline view that the US is going to go into recession early next year. We think that the recession is going to be somewhat shallow. I know everyone's getting bored of this word, but it's a shallow recession, which is maybe a little bit more prolonged. Now, on the other hand, if you do have the point where oil prices rise to $150, $200 a barrel, well, this is your stagflationary scenario where you not only do you have a very prolonged recession, but you have a very, very deep recession. So I think this changes the narrative very significantly. And given that it is, I think the tail risk is a little bit higher percentage chance than what you typically associate with tail risks, it does mean that within portfolios, you have to be very defensive.
Seema, we have about a minute here. I'm curious, when you say a very deep recession, what kind of historical precedent are we talking about? I mean, we've seen plenty of recessions from the 70s, from the arguably the late 80s as well, and even 2008. But I'm curious what actually applies here when we're talking about a deep recession, perhaps spurred on by this kind of inflation.
So this is your stagflation scenario. It's not the global financial crisis. That was a very, very different kind of beast in terms of the various imbalances that had built up over the time that had to be drawn down. This is more like your 1970s stagflationary effect. In some ways more concerning, but again, it's a slightly different picture. So there are some comparisons, and certainly from an investment perspective, it's something that we all need to be cognizant of as we're positioning. And as I said, that's one of the reasons that even if you do have hopes that the US can come out of this late in 2023, even potentially for Europe, there still has to be some defensive positioning within there. And again, that's actually one of the reasons that we still like real assets. This is still an inflation-led story. Even in your baseline, your downside scenario, this is where inflation is leading the way. And it's why real assets really outperform.
Seema, always great to catch up. Really enjoyed the analysis. Thank you very much indeed. Seema Shah, Chief Global Strategist at Principal Global Investors. Still ahead, the US Treasury Secretary and China's Vice Premier talking tariffs. The Biden administration may be about to roll back some of them, may increase others. Details to follow. This is Bloomberg.
We are getting some breaking news here, this time out of Germany. Germany may get up to a 25% stake in Uniper, that according to Handelsblatt. This, of course, is the German gas giant. We know that Germany has been looking for ways to kind of help that industry as well. We're looking at a potential bailout package of as much as 9 billion euros, $9.4 billion, if you want to look at it from that stand. And it's really not just the only one they're looking at. They're also perhaps looking at other ways that they can really help that industry. A lot of analysts saying right now that if Germany really falls because of this gas issue, that could mean the fall of the entirety of Europe. We're, of course, going to stick with that story and bring you any headlines related as we get there. But for now, let's go from Europe to China. China and the United States discussing Trump-era tariffs that President Biden is looking to ease. Chinese Vice Premier Li He told U.S. Treasury Secretary Janet Yellen in a video call that these tariffs are a source of concern. Bloomberg's Washington correspondent Anne-Marie Hordern has the details. Anne-Marie, we're looking at about 20% tariffs on both sides. What are the odds that these are actually decreased or even completely eliminated?
Well, we just don't know yet. For months, the administration has been debating this, and ultimately the decision will come from the president, who's been given a number of options on whether to lift those Trump-era tariffs or not. But the divide within the administration is very clear. You have last month Secretary Yellen, who also was on the phone with China's vice premier. She said last month that they want to reconfigure those tariffs. At the same time, you have Ambassador Tai saying that these tariffs offer her leverage. That is the word she used. And she said that any sort of impact on inflation will be marginal. And when you look at what Barclays is saying, they're saying about 0.3 of a percentage point potentially could be shaved off inflation. So what the president needs to do is decide whether or not, on one hand, remember we are going into the midterm elections, on one hand, the Republicans may use lifting those tariffs as a means to call the administration soft on China. On the other hand, the president has said he will do anything in his power to bring down inflation, because inflation is what the electorate is worried about, and that keeps showing up poll after poll after poll.
Anne-Marie, how targeted could this be? Could the president reduce tariffs on, say, back-to-school goods, but increase them elsewhere? Is this a zero-sum game, just playing with the levels on different areas that are currently experiencing these tariffs?
Well, Secretary Raimondo had said recently to CNN, it's consumer goods, things like bicycles. So if it's going to help the president, he would probably want it more help with more things like gasoline, with groceries, and these tariffs would not hit that. But potentially, if the administration were to lift some of these tariffs, it would be $1 billion of consumer goods. Then potentially there would be a probe into other subsidies in the Chinese economy. So it could be a more targeted approach to other issues they have with China, while at the same time lifting tariffs on consumer goods to try to help the everyday consumer. We should also note this won't be a light switch. This would take months to potentially drip down to the price consumers are paying when they check out for these goods.
Anne-Marie, we have about 30 seconds here. I'm curious how this balances out with some of the geopolitical tensions, specifically any sort of alliances that China and Russia have at the moment.
Well, Secretary of Treasury Janet Yellen had mentioned Russia in her call, as well as China's unfair market practices, and they said that it was candid. But we should also look forward to a meeting that we found out about this morning, when Secretary Blinken goes to Indonesia to meet with his G20 counterparts. He will also be sitting down with the China Foreign Ministry. So this story is not ending here.
Anne-Marie, we will certainly keep a careful eye on it. Thank you very much indeed. Bloomberg's Anne-Marie Hordern joining us from the White House, back at the White House. Coming up, we got a better than expected number for US factory orders in May. Ravin Gandhi, what does it mean for his business? He's the CEO of GMM Non-Stick Coatings. I have to say, last time we spoke, fairly downbeat. Have things improved? This is Bloomberg.
We're about an hour into the U.S. trading day. Bloomberg's Katie Greifeld is tracking the moves. Katie, what do you see?
Well, we're already off by about 2% in the S&P 500 after Friday's big rally, and that shouldn't be any surprise because of the last 15 times that we saw the S&P 500 gain by 1% or more. 13 of those times were followed by a fall. Definitely seeing that today. No love for stocks, but a big bid into the dollar. If we look at the euro-dollar pair, that is the most actively traded currency pair. We are officially on parity watch. You can see the euro is at its weakest level to the dollar since 2002. That was a long time ago. And of the other big headlines that we had crossing the wire this morning, also taking a look at Ford. So we know that chip makers have been a huge problem for the automakers. Ford was actually a bit of a bright spot. You saw 2Q auto sales actually increase by 1.8%. You compare that to double-digit losses for some of its peers, but Ford shares getting no love today because this is a market that is obsessed with economic growth. There was a great note from Neil Dutt of Renaissance Macro this morning saying that This is a recession trade, and you can absolutely see that in the intraday price action. You can see that banks are down, you have energy down, you have chip makers down as well. Energy actually off by 4%. So not really a hint of risk appetite when you look at this board, Creedy.
Bloomberg's Katie Greifeld, thank you as always. From the markets to the economy, one of the big economic releases we're watching this week is Fed minutes out tomorrow. Bloomberg's international economics and policy correspondent Michael McKee joins us right now. Mike, what should we be watching? Tell us everything.
Well, we're going to look for any hint about what the Fed was thinking. Now, remember, this is going to be 3-week-old data, what they were thinking about the possibility of recession at the time they met, and what they thought the possibility of inflation coming down would be, maybe what the mechanics of that are. There's not really much confusion about what the Fed wants to do and thinks it has to do. Jay Powell's been out and about speaking quite a bit. Other members of the Fed have been as well. But given the gloom hanging over Wall Street, there will be a lot of interest in anything they can glean out of what's in the minutes.
Is the expectation, is the risk here, Mike, that actually this set of minutes signals that the Fed is going to be even more hawkish than maybe we've been signaled to thus far? As you say, kind of post the last meeting, all of the narrative, we've heard it from Powell, we've heard it from everybody else, has been fairly hawkish. Well, is there a danger within these minutes that actually it's even more hawkish? Where does the risk lie, that they're more hawkish or more dovish?
I mean, you hate to say that Wall Street can misinterpret things, but they can. Yeah. And I suppose that the risk would be more hawkish, even though these are 3 weeks old and we've had more data since then, and we're going to get the jobs data on Friday. The two St. Louis guys, Chris Waller and Jim Bullard, who've been out front in saying the Fed needed to do more, are both speaking on the economy and monetary policy on Thursday. So a lot of different information could be coming into the markets that supersede the minutes. But if the minutes are seen as particularly hawkish, you're right, we may get an adverse reaction.
Mike, to what extent is the market ahead of the Fed, so to speak? It seemed like for a while it was kind of this game of who could be even more hawkish, the market or some of these members of the Federal Reserve. But I have to ask, does that dynamic still exist, given that we now have 75 basis points in the rearview mirror?
It seems to be easing up a little bit now that the Fed has sort of caught up. For a long time, the market was ahead of the Fed. The Fed didn't mind that. It sort of let people know what it was going to do over the longer term and let the markets find an equilibrium price. And the markets moved up to where the Fed basically is now. I mean, across the curve, we're above the Fed's version of neutral. The question is, what comes next? And the markets are already ahead of the Fed in that regard and deciding that maybe a recession comes next and the Fed's going to have to cut interest rates. That's farther down the road, but we do see the market already, if you look at the WIRP function on the Bloomberg, already paring back from 75 basis points in September to 50 now, and we'll see how the data treat it going forward.
What is a labour market report Friday that could knock the Fed off course?
Well, a really strong one would really bother the markets and the Fed because they would have to take maybe stronger action to bring down inflation if we're getting so many jobs created. If we get a really weak one, that'll raise questions about whether the Fed has put us into recession already. So it could go either way. But if we come in on consensus, then that's kind of where the Fed wants to be, a slowing economy, but not a falling economy. 275,000 or so jobs is a very strong report, but it's nothing like we have had. So everybody could digest that. And we want to watch the unemployment rate because of the so-called SOM rule. If you rise above 0.5 percentage point in unemployment, it signals recession. And so far, we haven't risen at all. We've actually come down 1/10 since the quarter began. So that's another thing to keep an eye on.
Mike, looking forward to the coverage out of D.C. We've got minutes tomorrow. We've got payrolls on Friday. Bloomberg's Mike McKee is going to be all over it. Let's get back to that question of what is happening with the global economy. The weak euro, obviously a huge signal at the moment about what is happening in Europe. We're going to watch the data out of the States very carefully as well. What's happening in China, what's happening in India. Let's take the temperature now with Raveen Gandhi, CEO of GMM Non-Stick Coatings, one of the world's biggest suppliers of non-stick coatings to household names such as KitchenAid and Pyrex. He's always a great guy to talk to because he gives us the temperature of what's actually happening in the industrial and retail sector. Raveen, thank you very much indeed for your time. Last time we caught up with you, you were feeling pretty downbeat. You were wondering whether or not we were heading towards or already in a recession. Has anything improved?
No, I think we are in a recession. We're sitting here in July, and normally we would be in the busiest phase of the year for us by far for Christmas production, and we aren't that busy. We are down 15% year over year, which is the worst delta I've experienced since I started this business in 2007. We expect it to be up about 10%. So I think we're going to have a pretty brutal second half. I think that there's going to be a lot of negative surprises in Q3, maybe in Q4. In the long run, I think 2023 is going to be a lot better, but I think 2022 is going to be a rocky ride.
Raveen, let's talk a little bit about the tariff situation here. You have reports saying that the White House is actually considering easing some of those tariffs. We're looking at about 20% on both sides. How much of a difference, in your opinion, could that actually make to the situation?
You know, I spoke out quite a bit against the tariffs. I just think tariffs are always a bad idea. So in an area, and what do tariffs do? They make prices go up. What are consumers hurting with right now? Prices going up, particularly on durable goods. So I definitely think the tariffs should be taken away. I know there's a lot of political game theory involved with what Biden, whether he looks weak against China, but I just think that existentially tariffs are always a bad idea.
Give us the geographical breakdown, talking of tariffs, as to where the different pieces of the global economy are right now. Clearly, Europe is finding life very, very difficult. Maybe some signs of a slowdown in the United States. What about Asia? What are you seeing more broadly?
Okay, so I would say the worst local economy that we sell into right now is China. And I think the reasons are there are certain areas in China, like we have a partner facility in Shanghai, where they were actually locked down for a while. So China's the worst. Then I would say America, second worst from my perspective. Europe, I know this flies in the face a little bit of the data that you guys have been talking about. Europe is a little bit ahead of America. And the strongest economy that we are experiencing right now is India. India is still growing at a pretty good clip. So that's how we see it with our global production.
Well, speaking of India, let's talk about the emerging market complex broadly, because a lot of these commodity inflation, well, it's coming also from the likes of Brazil, the likes of Argentina, Colombia, even a lot of these kind of export-oriented economies. I have to ask, how much attention are you paying to that part of the world?
Well, I would say broadly from a commodity perspective, I mean, most of my raw materials are plastics that are derived from petroleum. And if there is one piece of good news I can give you, it's that we have not seen as dramatic of price increases from our key our vendors this year. So that I think is actually potentially peaked. So from my perspective, the big question is really about the consumer. But on the commodity front, I'm actually, somewhat dovish.
What about labor?
Labor is up. I mean, labor is up across the board. I absolutely don't see an end to that. I'm hoping that things are peaking right now, but part of what I said earlier about the rocky road and the negative surprises we're going to see in the next 2 quarters, I think you're going to see a lot of very tough prints, from a labor inflation perspective, through the end of the year.
Raveen, let's stick with the labor question. How much of that is factoring into your own decisions and how you're operating your company? I mean, are you paying your employees more? Are you starting to feel the pinch on that end?
Yeah, I mean, we've been feeling that pinch for well over a year. We are still hiring very, very slowly. When I was on here, I think a couple months ago, I talked about the fact that we were trying to slow down hiring a lot because we saw this negativity happening. I'm unfortunately seem to be right so far with my business, but it's, we always want to grow. And as much as I'm talking gloom and doom here, in the long run, I think 2023 is going to be better. We're still building facilities in Asia. We're still hiring people. So I'm just hoping things go, we get the pain over with, we take our medicine, and then we can keep growing.
Let's talk about the strong dollar. What effect is that having? A, on your bottom line, because presumably, as we've just discussed, you have a great deal of earnings coming in from abroad. And B, what impact does it have in terms of your ability to deal with the inflation narrative that you're seeing in the States and be able to pass that on more broadly elsewhere?
Well, yeah, the dollar, I mean, look, I'm fundamentally a strong dollar guy. I think it's very good for America to have a strong currency, but it does make running a global business very challenging. We have facilities in Asia, we have facilities in Europe, so we don't really play the currencies per se. We don't hedge anything like that, whether it's from our sales perspective or from our raw materials perspective. But it makes things very, very complicated. That's for sure.
From a raw materials perspective, but I have to ask, how are you looking at that currency dynamic when it comes to perhaps bringing your profits back to the States and converting it to the dollar? I mean, how much of a squeeze are you seeing on the bottom line?
Yeah, it is. GMM was acquired by a multi-billion-dollar Japanese company a few years ago. So we have a lot of very complicated things going on in terms of earning in renminbi, earning in rupees, earning in dollars. It's definitely having an impact, but it's not one of my biggest concerns at this point. If it keeps going, I think it's going to be harder. I think the rupee, it's almost at 80. It's about 79. So if it keeps going, it is going to start impacting how we might have to price things. But for right now, it's something we're watching really, really carefully.
Raveen Gandhi, GMM Non-Stick Coating CEO, we thank you as always for a truly global perspective, the macro and the micro. We appreciate it as always. Coming up, the euro hasn't been this low against the dollar in 2 decades. We're going to take a look at what might happen next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta. You're looking at a live shot of the principal room. Coming up, Anita Markowska, Jefferies' chief financial economist, joining Bloomberg Television, 1:30 p.m. New York time. This is Bloomberg. Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. The mayor of Highland Park, Illinois, says the gun used in the deadly attack on a 4th of July parade was legally obtained. Nancy Rochering suggested to NBC News that the country needs to, quote, re-examine the laws. A 22-year-old man has been arrested in the connection with the shooting. 6 people were killed. Dozens more were wounded. The new leader of Hong Kong is signaling a cautious approach towards the coronavirus. John Lee says the city must balance travel inconvenience with limiting the spread of COVID. He also warned that people in Hong Kong should only be allowed to go about their normal activities once they have identified as not being infected. And London has a 2-tier home market at the moment. Apartment values are down 11% from their peak almost 2 years ago to a median of less than $485,000. Meanwhile, the median price for a house has reached a new high of $768,000. The mixed picture suggests the steam is starting to come out of London's property market. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg City.
Ritika, thank you as always. Let's take a look at the currency picture. The euro sliding to a 20-year low against the U.S. dollar. Traders betting the ECB will go slower on raising interest rates. Vincent Signorella, macro strategist at Bloomberg, joins us now, and the voice, I should say, of the Bloomberg Audio Squawk SQUA folks on your terminal. Vince, you have traded across several trading floors across New York, and I'd arguably say around the country as well. You specifically traded euro dollar. This is why our clients should listen to you, our viewers should listen to you. What are the ripple effects here of euro dollar not just hitting parity, but going even weaker?
Well, I mean, it's a good news for the U.S. from an inflation standpoint. The higher the dollar does ease prices, at least it's supposed to, if those prices are price savings are passed along. For the euro, it's a long story. It's the big picture. It's dollar strength. And dollar strength coming from equity weakness. There's been a sell-off in equities globally, and here in the United States, when you see that sell-off, there's a very, very good inverse correlation that's been going on since about March between the dollar and the S&P cash. And if you just look at 1 day's trading this morning, for instance, the S&P futures turned lower, and about 15 minutes later, the broad dollar future indexes turned lower. So that correlation is still with us. Doesn't look like we're seeing an end in sight yet for the bottom in the equity market. We're likely to continue then to see a stronger dollar. But even when that correlation turns and fades and we don't see equities giving the US dollar a lift, there are many, many other things out there that put the dollar in the driver's seat. The real yields in the US higher than they are in Europe. The Fed anticipating to go another 75 basis points this month, where the ECB, as you just mentioned, is expected to go on a slower pace. So that puts the dollar at a significant advantage. And let's face it, do you really want to own euros while there's a war going on in Ukraine? So a lot of things working against it.
Question from a viewer, Vince. If the ECB, when the ECB gets the depot rate back into neutral territory, i.e. above zero, at zero, does that create enough momentum to keep the euro from falling through one to the dollar?
Not so sure. I think, like I said, there are so many other things, so many other factors weighing on the euro. I don't see the ECB in and of itself as becoming the savior. I do think, very interestingly, though, and this is, I'm sure, against the majority, I think the ECB is actually making a more credible move than the Federal Reserve. I think the Fed is acting irrationally. I think they're trying to preserve credibility, as seeing as they're catching up for when they broadly missed that inflation obviously wasn't transitory. And I think they're rushing to try to catch up when the market in and of itself, as we can see, is basically telling them slow down. I mean, traders are pricing an interest rate cut not very far into the future, and the Fed is not acknowledging the slowdown. Right. We've had a first quarter that's been negative growth. Your previous guest, I agree with. I think we are in a recession. It'll be proven when we get numbers for the second quarter. And raising rates in a recession, regardless of where inflation is makes no sense to me.
Vince, about 30 seconds here. I have to ask, what's the next level to watch on euro dollars?
I think we're going to see parity in the very near future. So that 100 level should provide substantial support, even if nothing else, with the gamma delta hedging in the option space. There are knockouts for sure at 100. I would have bought one, so I'm sure some other people have as well.
Vince, always great to catch up. Thank you, sir. Bloomberg Vincent Signorella on what is happening in the FX market. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The price of copper has fallen to its lowest level in 17 months. The metal is widely considered an economic bellwether. It's now trading below $8,000 a ton, as a group metals just posted their worst quarterly slump since the 2008 financial crisis. Troubled crypto lender Vold says it has signed a tentative agreement to be acquired by rival Nexo. No word on the price. On Monday, Vold announced it was freezing withdrawals. The Singapore-based company is in the latest amongst several crypto lenders to resort to emergency measures after the digital asset market rout. And sales at Ford soared more than 31% in June thanks to big gains from its top-selling pickup line. Deliveries on the F-Series trucks were up some 26% from a year ago. They include the electric F-150 Lightning. Ford is now the second bestseller of plug-in models behind Tesla. And British Airways is scrapping more flights from its summer schedule. Like a lot of carriers, BA wants to end last-minute cancellations caused in part by staff shortages. British Airways has now reduced its timetable by 11% through October. The UK government has waived rules that requires airlines to use takeoff and landing slots or lose them the next season. And that is your latest Business Flash. Guy.
Ritika, thank you very much indeed. It's going to be an interesting summer for European travel. Talking of European travel, it's going to be a big feature of the European close. SAS also filing for bankruptcy. That's another story that we're going to be focusing on. The European economy looks like it is in a tough place right now. That is being very much reflected in the European markets more broadly, and in particular in euro-dollar. Euro-dollar now trading 102.45. Look at that. You've got the Stock 600 down by 1.75%. You've got the German 10-year yield, as you can see, catching a little bit of a bid, coming down sharply once again. We're going to talk about all of this with Dominic Bunning. He is HSBC's head of European FX research. He is going to be joining us next to give us his take on this. Clearly, the story, Critty, is are we going to see parity? Are we going to see below parity? And within Europe, what happens there as well? What happens Euro-Swissy? What happens with the euro versus the pound? That's also an interesting trade to watch too.
And it's not just what's going on in Europe. Let's broaden this out. I mean, you're looking at some pretty record Japanese weakness. You're looking at ripple effects in the yuan, the Korean won as well, those export economies. And then you have to look at the rest of those emerging markets, a lot of which are supposed to be kind of this no-brainer trade. If you're betting on commodities, you're betting on those commodity-based currencies as well. And is that a trade, Guy, that's going to start to unravel?
I simply don't know how all this is going to play out. The reason for that is that I don't understand yet what the energy dynamic is going to look like in Europe this winter. We have got a big date coming up. Gazprom is about to turn off Nord Stream 1. This is the huge pipeline that brings Russian gas into Europe, directly into Germany. It is down for maintenance. How long is it down for? Could it be an extended period of time? Because that's going to have a meaningful impact on the supplies that Europe can put to one side as it prepares for winter. Really hard call, really tough call, I think, euro-dollar for the rest of this year and what is happening with the European economy. And that, as you say, will ripple around the world. The Bank of Japan in a really difficult place. That research coming up from HSBC. This is Bloomberg.